Welcome to another episode of Elephant Corner Financial Lab. My name is Nev Kraguljevic. I'm a financial planner. And in today's episode, we're going to be talking about some year-end tax strategies for business owners. So if you are a business owner, you definitely want to pay attention and listen to some of the thoughts and ideas that maybe you could implement in your own life. Now, before we get started, I am not a tax advisor. I cannot give a tax advice, and this is not financial advice either. This is just giving you some education information that hopefully will help you as you are navigating your own financial lives and thinking through, hey, it's the end of the year. I've looked at my profits. I see that I can make a whole lot more money. What are some of the tax strategies that maybe I can reduce my tax bill legally, ethically, morally, etc.? So let's get going and talk about a few different options that we have. I'm going to go to our whiteboard, and one of the first ones that I like to think about is the S Corp. So if you are a business owner and you don't have an S corporation, or you're not incorporated, you maybe have an LLC because you haven't made a whole lot of money. Typically, it's going to depend on the income, but for vast majority of folks, for vast majority of businesses, it's right around the 50,000 in profit, not just what comes in, but like after all of the expenses, you might be able to benefit from S corp setup. Now, that's a fairly typical and easy thing to do. One of the pieces to think about is that you don't necessarily need to reorganize your business. You just need to file a tax form with your CPA or EA that is going to help you basically see how you are being taxed, and it can be done retroactively. So even though we are doing this now in December of 2025, we could apply it all the way to January and moving forward. Now, if you, for whatever reason, had an unusually successful year, but typically you're like, something miraculous happened, I don't know that it's going to repeat, it might not be the best idea to do. However, it is something that is sort of going and regular. It might not be a worse idea to consider doing the S Corp. And here is the reason why. So a lot of times folks want to know, like, why. There's a thing called the self-employment tax. Yeah. And self-employment tax is a part that we're paying, and that's going to be, you as an employee pay tax for Social Security, for Medicare, for that kind of stuff, right? The FICA taxes. And you pay it as employee, but you also pay it as employer. And so we're looking at about 15.3% that you're paying. Now, with S Corp, what ends up happening is that we would take this component on all of the earnings and divide it in portions. So you would take a reasonable salary as a W-2, and then you would take the rest of the profits from the business. Now, this will still have FICA taxes. However, this one will not. This can benefit some of the folks because you're able to reduce some of that 15.3% and get it without that FICA tax. So that's strategy number one. Let's go to strategy number two that I really, really like. And this is going to be what is known as bonus deduction. Again, not applicable to everybody, but if you are in a business where you need to buy large equipment, maybe you need a vehicle, maybe you need a new exam table, or a lab equipment, or computers, cameras, again, depending on what your business is, being able to go with the bonus deduction is what it does is basically takes the amount of money that is costing that, and you don't even have to pay the full amount. You can actually finance it. So say, for example, you buy a vehicle that you're using for business. You can, even if you finance it and you put, you trade in and you don't put any money down, or you get 0% down, or you put 10% down, whatever. Even if you finance it, the total cost of it, as long as you put it in service, can be deducted, and then you take deductions along the way. What that does is reduces your taxable income, and that is one of the strategies that can be very beneficial. It can also be combined with the Section 179. But again, everybody's strategy, everybody's financial life is different. I have no clue what yours is. So you definitely want to check with your tax advisor what does or doesn't make sense for you and for your situation. One of the things that I do want to mention is don't buy it just so you can get a tax deduction. Like, buy it if you actually really need it. But if you do, note that there is an opportunity and a potential to do it. So if it was, because it is December, let's say, I'm a financial planner, so like, for me, a computer is a really, really important piece. So if I know I need a new computer because the one that I have is about to die, or it's old or whatever, I need something faster, I need something better, I could wait and buy it in January. Or if I have additional income this year, part of the strategy is just buy it before the year's end, and that way I can claim the business deduction. So that's strategy number 2. Let's go to strategy number 3. This one will be the year end meeting. As a business owner, when we have corporations or LLCs, we have to keep the books, and we have to plan, and we have to do our annual meetings and take the notes and everything else. So this year-end meeting is a great time to sort of look at everything, plan for the future. And if you are a small business owner, typically your family is, or at least should be, part of the advisory committee, a board, and so on. And so one of the things that you can do is, for towards the year end, maybe you go away somewhere. Maybe you go, maybe your parents are on the advisory committee. Maybe your kids are on the advisory committee. Maybe everybody's on the advisory committee. And so when you go home for the holidays or people come over, a lot of that expenses can be regular and necessary business expenses, because you do have to plan, you do have to strategize, you do have to review things. And so you have ability now to write off some of the expenses. And get creative. Again, make sure you talk to your tax advisor. So that's strategy number 3. Now, here is one of my absolutely all-time favorite for business owners with kids: getting your kid on payroll. So, kid on payroll. Okay. Now, obviously, if you have like a 1-year-old, I don't know if they're going to be able to do much of anything. But if they are, teenagers, or even if they are 10, 11, 12, right? Like, they are old enough to be able to do some tasks. They already probably have chores at home to help with cleaning, organizing, shredding, putting mailing labels, stuffing the envelopes. There's all kinds of stuff that you can do. And I remember as a kid, I would go. My mom worked at a bank. She didn't have her own business, but I would go to the office because I liked being around her, and I thought I was being very adult. And so she would give me these little tasks to do. Like, I would, this is aging myself, but it wasn't computers. We didn't have computers at that time. It was a typewriter. And so she would give me this document that we had to make a multiple copies. She would show me how to do it, and I would just sit there and, entertain myself forever while helping my mom. Now, if this was her own business, she would have been able to actually pay me through the business, which becomes a payroll deduction or business deduction. And I wouldn't have to be on payroll. I wouldn't have to be a W-2. It would be 1099, or just, right, like somebody that is working a business. Maybe cleaning the office, right? Take out the trash, organize things, like things that kids can absolutely do. And the benefit of it is that now you're passing your income over to somebody that is in a lower tax bracket, and as long as they are earning below the standard deduction, make sure you check the federal and the state as well, then they don't have to file taxes. It's tax-free, but it is a write-off for the business. And so that's one of the great ways that you can reduce some of the tax costs and expenses and liabilities on your end, because you're still going to give money to the kids. So this way, sort of, you are helping yourself, but also teaching them an important lesson in business and work ethics, kind of how money works. And then if you are working with somebody like me, then you're going to know to say, ooh, from here we can actually create their IRA or a Roth IRA, which I even like better for the kiddos. And now you are setting up this child for an amazing future where they are able to now start creating their own retirement accounts that are going to benefit them down the line. So you are teaching them work ethic, you're teaching them about earning income, you're teaching them about saving and investing from early age, and you're passing a lot of lessons to your kiddos, to your legacy. But you're also saving on the taxes, and that's something I absolutely love. Now, let's go on to number 5. This one is amazing for business owners, but if you're not a business owner, you also can benefit from this one. It's just that business owners tend to have a little bit more stuff, which is why, I like working with business owners. I like working with everybody, but there's a lot of benefits, a lot of things that we can tweak around when it comes to business, that is different than folks that are just getting a W-2, just getting an income. So one of the pieces that you can do is invest in your retirement. Ooh, that's horrible writing. Let's try that again, y'all. Okay. Retirement. Okay. So one of the problems that I find is that a lot of times the business owners are doing really good job of setting up their business, running their business, being employed by their business, serving the customers and clients and patients that they have, but they're not so good about setting themselves up well for the future. And one of the pieces that if you are watching this video, if you're looking at your year-end stuff, you want to think through of, have I set up a retirement plan? If you have, you definitely want to fund it. If you have not, it is a good time to set it up. It has to be done before the year's end. There are tax benefits to it, depending which one you set up and how. That's for another video, that's for another conversation. But that's something that you can explore with your CPA, with your EA, with your tax professional, or even a financial planner to think through of what can I do now that will set me up well for the future so that we can start saving. Now, if you are W-2, obviously you might have, well, not obviously, but you might have things like 401k. You might be involved in employer's simple plan. Maybe you have 403b if you are in a nonprofit sector, education sector, maybe even 457. You want to absolutely maximize these if you can. And we're going to be doing a separate video that is just for the sort of like how to think about the retirement plans and some of the benefits. So make sure you get tuned in for that. But for right now, just to think through that there are a lot of things that we can do here to shift some of the income that you're getting right now and putting it towards your future. So that's strategy number 5. Now let's go on to the last of our strategies. That's strategy number 6. And this one I absolutely love because it can be done by anybody, including the business owners and self-employed folks and employees as well. And that strategy is called the HSA. Love the HSA. And if you can max it out, by goodness gracious, please do max it out. Now, why do we really like HSA? You've probably heard other advisors, other professionals talk about the HSA, and you might wonder, like, what is this big deal? Like, why do they get so excited about it? And the rest of us, like, I don't even know what that is. It's because it has triple tax advantage. That is super rare. So when you put money in it, you get a tax break on the bills. When you invest it, the money grows tax-free. Yes, you can invest it. And when you use it for qualified medical expenses, you get to pull money out without any taxes or penalties. And you can use it in a current year, 20 years from now, 30 years from now, it doesn't really matter. And as long as you keep the medical bills, you can actually reimburse yourself 10 years from now for the medical expense that you had today. So this is one of those things that are very cool about HSA. And when we tell folks, you definitely want to have it. This is not necessarily attached to how much money you're earning. This is not necessarily attached to what your tax liability is or any of that stuff. This is attached to the healthcare plan that you're selecting. And why I'm saying it's a year-end strategy is because it's still December and you basically have until the end of the year to select your next healthcare plan. Now, for some of you, the open enrollment might have ended. For some of you, open enrollment might be at a different time. But one of the things is to consider is to look for healthcare plans that offer HSA, and then make sure you fully fund it to the max. For 2026, the max is going to be $4,400 per year for a single individual, or it's going to be $8,750 for family. And family is basically like 2+ individuals. So even if you don't have a kiddos, and it's just you and your spouse, you can go all the way up to $8,750, which is a really, really cool thing that you can grow and you can benefit yourself, whether today or in the future. We talked about retirement. We talked about that 401k, 403b, simple SEP, depending on what you have available to you. Now, final piece is that you have now ability to also go in and leverage IRA. Now, IRA, okay, so this is our final strategy. It's $7,000 for the year in 2025, and you basically have until April 15th or whenever you take prior to you filing taxes. So say, for example, that you are doing everything right now, you're preparing, you're looking at your profit loss, you know that it's going to be more, you elect to be S corporation, you reduce some of those self-employment taxes, you start the retirement account, you start like a simple or a solo 401k if you're individually, right? Like if you're the solo owner, does not have employees, or just regular 401k. So you start some sort of retirement plan in collaboration with your tax professional. You select the HSA account, and comes the end of the year, the tax professional prepares everything, and you look at it and say, ooh, okay, I am slightly above the threshold, and maybe now I am peaking into the next tax bracket. Maybe you went from 22 to 24 and it's only about $5,000 or $7,000 difference. You have ability before you file to go in and contribute money for 2025 in 2026 to be able to reduce that and then lower your AGI. That's something that you can work with your tax professional. So if you don't know exactly where it is, but you need to tweak it, this is the last minute tweaks. The other piece is that it's also really important is that for some folks that don't have access to retirement, that haven't started it, you can utilize the IRA right now to lower some of those taxes and be able to help yourself save for the future. So here you go, folks. 7 different ways that you as a business owner can reduce your tax liabilities, set yourself up well for the future, and rock it in 2026. Thanks for watching, and until next time, stay money blessed.